Good afternoon once again, everybody. Hope everybody's having a great day. I will tell you, this is Jeff Benson coming to you from sunny Jacksonville, Florida. This is another one in our series of educational webinars really related to builder's risk. Keep in mind, we get into a lot of different aspects of insurance in these things, which hopefully we kind of whet your appetite, makes you want to study more, because I can't, in the limited amount of time we have, I can't cover everything in great detail. So I kind of touch on things, hopefully piques your interest and you do some further studying. And as always, you'll have my contact information. So if you want to continue the conversation later, give me a call or drop me an email. I'd love to hear from everybody. So without further ado, today's webinar is going to be, we're going to go for about 20 minutes and then open up to questions. I have a feeling we're going to have a lot of questions today, so look forward to those. We get asked questions all the time, and I got to tell you a little story. So I had an agent not too long ago call me and they said, Jeff, I think I could place this on a homeowner's policy and maybe save the insured a little money as opposed to placing it on a builder's risk with you. And they truly, I said, well, usually when you're saving money in insurance, you're going to give up some coverage. Would you not think that's logical? And they're like, yeah, but this and that. So we went back and forth a little bit, and I thought, this definitely is a topic that is misunderstood. Many times we have companies that are saying, oh, we'll do it on the homeowner's policy for you, or maybe we'll do it on the commercial property policy. And what I'll say is, as we get into this today a little bit, and at the summary, you're going to kind of hear that, builder's risk is a better coverage form for this exposure. That's kind of the bottom line. Builder's risk is a subset of inland marine. Inland marine is property that's in transit. So everything that the coverage is designed for is to cover property that's moving somewhere. So you have property that's in transit, it's temporarily stored at another location, it's on a job site, but it's not installed yet. All of that property is covered on the builder's risk. Is that covered on the permanent property homeowners CPP policy? Maybe, maybe not. So that's one aspect of it. And the other aspect that we're going to get into today, which I think is going to be kind of interesting, is we're going to talk about relationships. So you can say, I went to this webinar today and this guy was talking about relationships. It's quite not the relationships you're thinking about, I guess, but we're going to talk about the relationship you have with your insured, or should have, and the relationship the different types of insureds relative to construction projects have with each other. So just remember that. So we're going to have relationships today, and we're going to talk about real property and things that could happen to it. So let's get into this. Insurable interest. I was going to memorize this definition. I'm going to read it to you real quick, because really at the heart of all property insurance is insurable interest. Insurable interest is a person or entity's real financial interest in an object. The interest being the fact that the person or entity will suffer financially if the insured object is damaged or destroyed. So think about that for a second. So in order to get recovery under property insurance, you have to have a financial interest. And I will say this too, financial interest is actually a statute in most states, and they define it. Most states very similar to what we talk about. But as always, I can't cover 50 states today. So if you really want to dig into insurable interest in your state, pull the statute and we'll talk about it. But having said that, that really is the basis of property insurance. And when do you think an insurable interest needs to be there in order to recover? A little bit of a trick question. When you write a life insurance policy, they have to have insurable interest at the time the policy is written. In property insurance, in order to recover in a claim, there must be a financial interest at the time of the claim. So think about that. It could actually change. When you wrote the policy, maybe very little, if any, insurable interest, but at the time of the claim, there was more. That implies a project that's ongoing and being built. So think about that. So let's talk a little bit about relationships and the different types of insureds on a construction project. First of all, owner, developer. You have someone that owns the building, they own the land, and they're going to build it. So that's the owner, simple enough. Next you have is the general contractor, someone that oversees the construction of the project. In residential terms, we call them paper general contractors. Many times they don't have employees. It's just a supervisor. Big general contractors, commercial general contractors, maybe have some employees, but they oversee the overall project. Obviously, you have the subcontractor, the trade contractors, the electricians, the plumbers, the framers, the roofers, so on and so forth. And then lastly, you could have an owner acting as a general contractor. So those are the different entities that we're going to talk a little bit about today. And I'm going to go back to this relationship piece. Think about the relationship that you have with your insured. So you need to ask yourself, who is my insured? Which one of these entities on this screen is my insured? So the number one thing you have to do as an agent is to take care of the risk that that particular entity has. The reason I say that is it might be a little different if they're the owner as opposed to the general contractor. And I think this goes without saying, but just keep that in the back of your mind. In our Builders Risk program that I underwrite here out of Jacksonville, we have about 2/3 of our insureds are general contractors and about 1/3 are owner developers. So it really doesn't matter to us from an underwriting standpoint who the named insured is. What we're going to do is underwrite the risk and make sure we know what we're doing. We are going to underwrite the construction entity to make sure they know what they're doing. But if the owner is the named insured, that's okay. Now, I'm going to tell you today, it's best to have both parties named on the policy. And we're going to get into a little bit of discussion today about additional insureds versus loss payees versus mortgagees. A little bit of difference there, but just make sure that both the parties are named on the builder's risk policy. And this is going to make more sense as we talk about comparing builder's risk to homeowners or the CPP. Named insured versus additional insured. I've always thought, well, maybe there's no difference. Actually, there could be a little bit of a difference. First of all, the named insured is responsible for the deductible. That's interesting, because what if you had a percentage wind deductible on a very large commercial project? The named insured's got to pay that deductible. So if the GC is the named insured, guess who's paying the deductible? If the owner is the named insured, you get the point. So the other thing is additional insured versus named insured. You got to ask yourself, you have to identify their insurable interest in the project. A GC has different insurable interest than the owner does. So maybe there's a time element exposure. Maybe there's property in transit. We're going to get into some of that in a second. But for the first thing you need to ask yourself is, am I adequately protecting my insured, be it the owner or the GC? Criteria for specific limits of coverages may be required from the additional insured. So keep in mind, the other thing that we might have is a contract that states that certain limits have to be carried. So you got to be careful. Let's just say I'm the owner and I'm saying, all right, Mr. GC, you carry the insurance. You'd better verify that the GC purchased the correct policy with the correct limits in order to meet the criteria of, let's say, the mortgagee, the person that's lending the money. They have certain criteria. So once again, relationships, the relationship you have with your insured, the relationships that all of your insureds have with each other. It's very critical to understanding this. Homeowners versus builder's risk. So this is an easy one. So we have a homeowner's policy and we're going to compare that to the builder's risk. The first thing I'm going to ask is, what automatic coverages are built into each form? We're not going to get into the homeowners today because they vary, but on the builder's risk, the form that we use, we have 19 automatic coverages built in. And all those coverages are built in to cover different exposures that a contractor would have. So it could be the property in transit. Let's say you have the window package is being transported across town. So you have $50,000 worth of windows. Maybe the person responsible for transporting it has coverage, maybe not. On the builder's risk policy, there's automatic coverage for that transit exposure. What if the window package is delivered, you're not ready for it yet on the job site, and you're going to store it somewhere? That's temporary storage. Those windows are over there. We have coverage for that in the builder's risk policy. Subcontractor's interest. Sometimes the sub will have something delivered to the job site and it's sitting on the job site and somebody steals it. So that subcontractor's interest is covered on the builder's risk policy. As I said earlier, a time element, a form of time element would be soft cost. All the reoccurring expenses that could happen outside of labor, materials, and overhead, that could be covered on the builder's risk. If you think about all those things I just said, none of that stuff is covered on a homeowner's policy because the homeowners doesn't anticipate that. A homeowner's is permanent property. It's property that's sitting on a particular location, and that's the insurance you get for that, for the most part. So this is kind of an easy one. So which one would you choose? I think you would choose builder's risk. This one I get a lot of times. So we have a home and it's going to be renovated. So we insure these every day, and you can insure them a couple of different ways. Usually we insure the existing structure and the renovations. So you have two different exposures there. So you say, well, what if I'm in a home and I'll just add it to the homeowners, alterations and additions. So here's where you got to really dive into the homeowner's policy. Some policies have very limited coverage depending upon the scope of the project. It could be based on the value of the renovations compared to the existing structure. Could be on the actual scope of what they're doing. Are they adding a floor? Are they removing walls? All of that may limit coverage on the homeowner's policy. And another big one is it going to be vacant during renovation? Because once a home is vacant, there's no coverage on the homeowner's policy. So these are some major holes in homeowners policies. And I see this a lot. I see it a lot with high net worth, high value dwellings. And, there's going to be somebody who says, oh, we'll just put it on the homeowner's policy. No problem. I guess what I'm saying is you better review the homeowner's policy. And then, of course, as always, review your builder's risk policy to make sure you have the right coverages. But I think most of the time, 90% of the time, builder's risk is the way to go in these scenarios. The CPP versus builder's risk. It's a little trickier here. Let's say you have a commercial property policy and your insured has 3 buildings on it. Now they're going to build a 4th building. So you're saying, okay, well, I could get a builder's risk policy on that 4th building, or maybe I could just add it to my commercial property schedule. That might make sense. That's easier. Got to be very careful, once again, on the limitations of the CPP. Sometimes there's limitations to the value of newly constructed buildings. Many times there's a limitation to the length of time that you can add a newly constructed building. Let's say it's a 2-year project. The CPP might not contemplate that. So keep in mind that's a major problem that's going on there. The other thing is, what about the interest of the GC? I don't think the CPP cares about that. So all of these things, once again, kind of show the holes in permanent property insurance. It's just not designed to cover inland marine exposures, which a builder's risk is. Let's go over some of the coverages in the builder's risk really quick. I know you all know this, but theft, that might be under both of them, but there might be limitations on the homeowners and the CPP as far as not only the property covered, but to the limit what the value is covered. Property in transit, we covered that one, but it's definitely not covered. Temporary storage, which is a big thing in builder's risk in all construction projects, not covered on permanent. Expediting expenses, not covered. Soft cost, not covered. Delay in completion, which is our way of saying time element coverages, definitely not covered on the property policies. If you think about inland marine and builder's risk, it's one of the broadest forms of coverage that exists as far as property and all the things that could happen to that property and to that insured that causes financial damage. Flood and earthquake, once again, you got to make sure that's covered. Perhaps you have a flood policy, but it doesn't cover some of the things for a construction project. So you got to be very careful of the flood and the earthquake coverage that you place. I've seen some major holes in coverages out there. So let's real quick in a summary, and I know we went through this pretty quick. Hopefully we have a lot of questions because I think it did. But first of all, who is your client? Ask yourself, am I insuring the GC? Am I insuring the owner? Am I insuring both of them? That'd be nice. What about the subcontractor? Maybe I got to make sure they're taken care of. So these are all the things you got to ask yourself first is who is that? You got to identify their insurable interest. Remember we went to that definition of insurable interest? So identify every party that's involved in the project and what their insurable interest is. You need to understand that. Review the criteria required by additional insureds. Just a little tip here too. So you have additional insureds, you have lost payees, and you have mortgagees. 3 different entities that you're going to try to take care of. So there might be a time where you add the owner as a lost payee and you have the general contractor as the named insured. Might be a good way to do it. The difference between a lost payee and an additional insured is when there's a claim, the lost payee is going to get taken care of first. Kind of like a mortgagee, where the insurance company pays off the mortgage first and whatever's left over goes to the named insured. So there might be a good way to do that. And we also have another one. If you want to make the owner the named insured, we have a special endorsement called additional insured builder. It's just a way of clarifying that this builder has an insurable interest, financial interest in the project. It's a good way of doing it, a clean way of doing it. You need to understand the relationship all these parties have. There usually is a construction contract between the owner and the general. So these things can be written skewed one way or the other. So if you're going to have a separate deal where the GC is not named, that's probably not a good way to go. Because let's think about this. Let's say a project's being built and now there's a claim and it affects the GC from a time element standpoint, delay in completion. So maybe the owner is not out that money because it's not his exposure, but now we have a delay in the project. So instead of being able to move into the home, now they have to wait 6 months. Do you think that's a hardship for the family that's moving from Pittsburgh to Chicago? Probably is. So I guess the bottom line is you want to cover as much as you can in the builder's risk with both the GC and the owner. Ask yourself who has what to lose in the event of a claim. It's a good way of looking at it. So once again, let's think about the relationships we have with our insureds, the relationship they have with each other, and then let's think about the property we're insuring. Where is it? What's happening to it? Those are the questions you got to ask yourself. So hopefully we kind of cleared up a few things today. And as always, I'm always here to talk. If you want to give me a call or email me, that would be great. So I think what we're going to do now is open it up for questions. And I'm ready. Ask away.
All right, our first question is, I thought the difference between additional insured and lost payee was additional insured is related to liability and lost payee was related to property.
Not necessarily. I mean, you could be in an additional insured in a property form too. So it says additional insured. Like I said, it's just probably a way of a nomenclature of saying, I would prefer to do a lost payee for property. That's the preferable way to do it, but I have seen it done as a simple additional insured. They're still going to get a recovery for whatever they lost. It's just not quite as simple. And I think a lost payee makes it, like I said, the big difference is they're going to get paid first. So that's kind of makes most people happy if they, that's one way of looking at it.
Okay. Does an installation floater kind of overlap with a builder's risk policy?
Excellent question. So an installation floater basically is a derivative of a builder's risk policy, or back and forth. So usually what you see as an installation floater is for a subcontractor that is only interested in covering the property that they're responsible for. So you have an electrician, he wants to insure all his labor, his materials for his project, so he has an installation floater. Perhaps the GC has the coverage on the electrical on the overall project. So there actually could be two different insurance companies paying the same claim, which is usually a pain. The problem we have with that is if the subcontractor pays for his own insurance, he's going to build that into his bid, so he's going to be more expensive. The GC is going to say, no problem, I'll take care of it for you. Now, I will say, then it goes back to making sure you trust the GC to have the right policy to make sure everything's covered. So I guess what I'm saying is usually you'll see it done on a builder's risk, but I have seen installation floaters written for subcontractors, and there could be dual coverage. But it is interesting. It's really very similar coverages. The installation floater and builder's risk are very similar in many cases. Hopefully that helps.
All right, Jeff, can you go ahead and transition into the contact information slide? Someone is asking for your information.
Well, you want me to put my information up now?
Yes, please.
Oh, how about that? And
Wonderful.
as important as me is Donna Berry's our senior underwriter, so you can give Donna a call or send her an email. And she is the resident expert. We do builder's risk down here all day, every day. We'd love to hear from you. And some of these things, like I said, I touched on a lot of pretty broad, we could get into this a lot more detail. And if you have a very particular question about the insured, maybe they have a strange contract with their owner and you want to talk about that, by all means. I mean, we don't really review contracts down here, but we do get into the weeds a little bit. Keep in mind too, I cover kind of what's on our base form, and we have literally hundreds of endorsements that are available to tailor the coverage for a particular project. So, I mean, I just cover the very basics here. But in our standard form is better than just about anything out there, which is good. But if you have a unique exposure, don't hesitate to give us a call. We'll talk about it.
Okay, next question. If you have a commercial building with multiple tenants, what percentage of occupancy do you require the permission to occupy to be added?
That is another really good question. And we kind of stand, we think our coverage form is second to none. So the way we look at this is if it's a commercial structure, and we define commercial structure as anything other than 1 to 4 family detached dwellings, you do not need to add permission to occupy, or coverage doesn't cease until more than 75% of the space is leased or rented to others. So if you had a strip center and we insured the GC building the strip center, he could actually lease out 75% before we have to add permission to occupy. That's very broad in the market, and we're proud of that. But after it gets more than 75% occupied, it's about time for permanent insurance, I think. But we have been known to go even higher than that, but we would have to charge for permission to occupy after that. Good question.
Okay. How do you deal with the cost of demolition of an existing building on a project? Do you include the cost as part of hard costs?
Yeah, these guys are asking some great questions today. I really appreciate that. So we get a lot of times where they want to include the demolition cost on the builder's risk, and they probably do that because it's part of, I guess, part of the loan or part of something that they're dealing with the bank. To be honest with you, there is no coverage for demolition on a builder's risk policy. So sometimes I've been told, Jeff, go ahead and include it. We don't care. It's not covered. We're going to put it in. So it's like one of those kind of silly things that some people add in as the value on a builder's risk, even though there's no coverage for it. It's really up to you guys. I mean, technically I would say don't include it, but sometimes the banks make you include it. Keep in mind, this is property. We're not going to pay you to tear something down, not from a property standpoint. Clever though, I like that.
Okay, we see a lot of quote requests for builder's risk after construction has started. What is the absolute cutoff, and what are some tricks to get these already started projects covered?
Tricks. So I'm going to tell you how to trick the underwriters. How's that? That's pretty funny. So our general rule of thumb is 30%. So if you submit something to us and it's less than 30% completed, we have no problems. If it's more than 30%, I'm not going to say we're not going to do it. We're just going to start asking more questions like, what happened? Why didn't you insure the project? Many times we hear the GC thought the owner was going to get it. The owner thought the GC was going to get it. Sometimes, they think they're going to do cash. We don't need to cover builder's risk. And then they get some substantial values in there and they're going, wait a second, for 20 cents on the dollar, I can insure this. I probably should insure this now. You have to understand builder's risk is completed value. We go from 0 at risk to 100%. We want to get our premium up front, time value to money and all of that stuff. So when we have to wait, there's more exposure for us at the end. So The trick would be this, and you got to work this out with your underwriter, and I'm not going to speak for every underwriter out there, but how do we calculate percent complete? Is it time? We thought it was going to be a year project and we're 6 months into it, so it's 50% complete. Or is it value? $1 million, you've got 300,000 in it, so it's 30% complete. That's a matter of discretion with the underwriters. Maybe you can make it work for you as far as time versus values put in place, but you got to use one of those things to come up with that estimate. And a lot of times an underwriter, depending on your relationship with them, if the rule is 30% and you think it might be 25, it might be 35, I would always call and tell the underwriter, say, this is where I'm at. What do you think? You might be able to talk them into 25 because there's a matter of it's a little subjective in there in some of those rules. Now, if it's 90% complete, it's not going to happen. An underwriter is not going to do that. That's probably a Lloyd's exposure. How's that? Hope that helps.
All right. Do you insure the existing structure at ACV while the new construction is RC? Can you do both as RC?
Okay, so the renovations are always technically replacement cost. Renovation's a renovation. So I'll get that out of the way. On the existing structure, we do ACV because let's just say it's an older building. Could be an historical building. Could be, we did one the other day that was, I want to say maybe 300 years old, 280 years old. It was a very, very old building. We did it. So to do that on a replacement cost would not make any sense from an underwriting standpoint. But one thing that we can do is we have access to a stated value endorsement. So you and I can come to an agreement on the value of the existing structure and we'll write it at a stated value. So, that's the way we would do it. If you could talk an underwriter and do replacement costs on a 300-year-old building, good luck with that. That would be interesting. So hopefully that helps. But those are the things you need to give us a call on. We'll talk about it.
Okay. When doing a remodel, is it most common that the current building being insured on the CPP and the addition or value of the remodel insured on the builder's risk?
I've seen it both ways. A lot of times what we'll have, let's say we're doing work for a school and they're going to renovate the gymnasium. So they have a large CPP policy, has multiple buildings on it, and they feel comfortable leaving the existing structure on the CPP because there's no limitation on the renovation piece of it. So in those cases, it stays with the package master policy, the existing structure, and on our builder's risk policy, we just do the renovations. But you got to be careful here. Let's say it's a smaller insured and they have a CPP and there's limitations built into it as far as, like I said, the value of the renovation, the length of the renovation. Is it occupied? Is it not occupied? So it really depends on the smaller ones. I would probably say, no, you need to do both on the builder's risk. The larger the insured, the chances are it might probably be okay on the CPP. But once again, I would give us a call. We'll talk about it. Good question.
All right. Do you write builder's risk renovation that would include moving a bearing wall?
We call those major structural changes. And the answer is yes, we will do it, but we're going to underwrite it. We're going to ask a lot of questions. We're going to want to make sure that the builder has done this before. They know what they're doing. We're going to probably need a engineering letter. We're going to need some architect plan. We're going to need some underwriting information. It's something that we can't do. If you call me Friday at 4 and want to quote by 4:30, it's not going to happen. But we do it. We do take a look at it. We do entertain it. But there is a lot of exposure when you start moving lower bearing walls because what happens? Things fall down, they collapse. The biggest problem we see is builders that are maybe renovating a house and they run into this situation. They're like, oh, I've never done this before, but I think I'll be okay. So they move the wall and the whole thing falls down. We had a builder in Philadelphia, thought he could do it. He'd never done it before. He was messing around in the basement doing something and the whole building collapsed. And that was a big claim for us. So the big thing is to make sure the builders know what they're doing. They've done it before, the contractors. But we'll entertain it. Just give us a little more time and we're going to ask more questions. How's that?
All right. Could an installation floater cover the install of a pool?
Sure. I mean, there'd be a little underground work and there'll be some plumbing, concrete work, steel work. Yeah. I mean, that's when we write the builder's risk on a home being built and they're building a pool, it's all part of the project. That's another way of looking at it. Is anything that's part of a normal home being built could be written separately, either on a builder's risk or an installation floater. That would be fine. Good question.
All right. Can you do airport projects?
Yeah, like a runway or maybe a hangar they're going to keep the planes in. We would entertain that on builder's risk.
All right. For a multi-year project, how do you price the policy?
Okay, the ideal way for us on multi-year is to actually write a multi-year policy. If it's a 24-month project, I would rather write a 24-month policy, give you a rate up front, guarantee you a premium and a rate, and we're off and running for 24 months. If we do it on 12 months and say, okay, we'll extend it at the end of 12 months, we'll work with you. We would probably use the same rate, but you never know. And some companies are not quite the same as we are. Even though it's a 24-month policy, they'll write a 12-month policy. And then at the end of 12 months, they know they got you and they'll raise the rate for the second year. Okay, so ideally, I would rather write the policy for whatever length of time we can go up to 36 months. So if it's a 24-month policy or 30-month policy, let's go ahead and write it for that, as opposed to having to extend it multiple times, endorse the policy. It's kind of a pain. That's how we prefer to do it.
Can you have a builder's risk to cover just demolition?
Like I said, there is no builder's risk exposure to a demolition. You're going to tear a building down. There's no property value to me there. I guess you're concerned about the liability of tearing a building down, and that's not builder's risk. That's the casualty exposure. So you better have a good GL policy. But on the property side, there is no value to demolition. It's funny too, I get asked that question a lot. It comes up. I'm thinking, what do you want me to insure? You're tearing the building down. I'm not going to pay you to tear it down. I like that. It's kind of clever, but don't think we do very well underwriting wise there.
Right. How far into a project are you willing to provide builder's risk coverage?
I kind of answered that before. So our general guideline is 30%. Up to 30% flows through the system, we're off and running. It goes over 30% complete, you're going to submit it to us. We might do it, we might not do it. We're just going to ask more questions. And then at some point, we're going to say, no, it's too far along. But it is that's a little subjective, risk by risk, agent by agent. So give us a call, we'll talk to you. I get this sometimes. So a company wrote a builder's risk and the project was delayed. And so now we're 2 years into it, it's 90% complete. And the company has said, okay, we'll do it, but we're going to double the premium. So when you come to me and say, will you insure it? I don't like that price I got from the carrier that's on it now. I'm like, wait a second. So now you're asking me to insure a 90% complete building on a builder's risk with a builder's risk rate? I mean, that doesn't make any sense because we should have been on it from the beginning. We want to be on these things from the beginning. So at some point we wouldn't do it, but it's worth a conversation. By all means, give me a call or call Donna and we'll talk about it.
Thanks, Jeff. We have reached the end of our webinar. If your question has not been answered, Jeff will be reaching out to you.
Fantastic, guys and everybody. I appreciate your time today. Oh, stay tuned. We have another one coming up in September, I think on the 17th. Hopefully these things are beneficial and educational for you. And anytime you have ideas on new webinars, fire me an email and we'll see if we can't work it into the series. And I hope you guys all have a great day. Take care.